Dickey here, and I've had several clients question what's going on with the Credit Suisse and UBS merger, or whatever you want to call it. So I figured I'd take a moment and just put a little video together to explain what's happening and what it means in the scheme of things. Just to give you a general idea of what's going on here. If you look at the history of Credit Suisse, as you can notice, this trend has been going on for a very long time. This is not new. This is not something that just happened yesterday or in the last week or two. This has been going on for a long time. Credit Suisse has been mismanaged and not managed correct for a long period of time. The most recent stuff is, if you've seen some of my other videos, a lot of this has to do with liquidity and a run on a bank. And so right now what's happening is Credit Suisse is having a bunch of their accounts being not taken, but people are taking their money out of the bank, and which is making them sell investments they don't want to sell. And again, what they've done up to this point has been a huge problem. But in this particular situation, it's being exacerbated by the same thing that happened to SVB. They have treasury bills, they've got other long-term investments that are not necessarily bad. They're not toxic, they're not an issue. But on a liquidity basis, if you have investments that started at $100,000, now they're worth 40 because interest rates are at 4, and people are taking their money out and they have to sell these investments and take the losses, it's a problem. So again, it's not necessarily an issue for every bank. This is a bigger problem because of what's been going on with Credit Suisse since the beginning. Now, I do want to point out a couple things that are going on and what's being shown. So here's a Bloomberg. Now, the thing to remember about this is not a U.S. bank, okay? Now, they do some lending and they have some other issues that overall could be a rollover effect, but the Swiss government helped put this together. They helped put it together to try to stop this. And again, this has been going on for a long time, and I'm sure they just got tired of the baloney that's happening. So what is happening is UBS is paying $3.2 billion in US dollars. Now, please understand, everybody's freaking out about the stock valuation today. Oh, the stock went down so much. Here's the problem. Even at right now, the stock's down 52% today. This is getting a good deal. So the stock could easily go down a little more to make it equal what they're actually paying for it. And it wouldn't be a big issue because the shareholders are only getting that. Now, the other part of this that I want to discuss is that it's not ending the crisis. It's just ending the long-term problems with Credit Suisse. And again, they did push for it, and UBS has made a pretty good deal. Now, the other thing that the Swiss bank is doing is they're providing 108 billion US dollars in what they're calling liquidity, which is going to help the bank during this transition period not be out of whack on their numbers, because all banks have to fit certain guidelines as far as how much they've lent out so that they are liquid. So giving them, and this is not money they're necessarily going to have to use, or it is a line of credit, but it's really not anything they're probably using. It's just going to make it look like the bank's more stable than maybe it really is. The next part of it is they're going to guarantee $9 billion in potential losses. Again, these are potential, may or may not be an issue. Usually those end up going. I hate to be that way, but if the Federal Reserve of the United States is giving it, or in this case, the Swiss bank is offering it, most of the time the banks are going to take that $9 billion, which if that's all it costs to get this deal done and get Credit Suisse to not be a problem anymore, it's probably a bargain for them. And the other part of this is that the stockholders are getting hurt here. And the problem with that is that the bondholders are. And I know there's some contention about that. And the way this is going to work is that each shareholder that currently has Credit Suisse is going to get for every 22.48 shares, they're going to get 1 share of UBS stock. Okay. Again, it's barely worth $1 right now, so you just do the math and break it up. But the bondholders are getting nothing. So it's another one of these kind of halfway deals where some people are getting the shaft and some people aren't. Okay. So the stockholders, they're getting the shaft, but not as bad as the bondholders, because the bondholders are completely gone, which it normally doesn't work that way. Normally the bondholders, if it goes into bankruptcy, usually have a better stake than the shareholders. So it's kind of a partial deal, and we may see more of this down the road where governments step in to help a floundering company. But again, this one's kind of its own animal. This is not an SVB. This is not a signature that just came on. These guys have been having a problem for quite a while, and they have other problems besides what's happened with the other banks. But I figured I would at least give an update on this. The biggest issue here, folks, don't run on the banks, which again, this is not even a U.S. bank, but even the local banks. You have to be really far out to become a problem at the local banks. JP Morgan, thousands and thousands of clients. You just have to have such a huge run on. I don't know where you put your money. If you're taking out trillions of dollars, where are you going to put it? Again, some of these banks are smaller, and some of these guys took it out and messed things up. But when you look at some of these larger banks, which it may be that some of these smaller banks get gobbled up, like I say, some of this may end up happening. We've got some issues now with First Republic being an issue later on today. So we may see something similar to this to figure out First Republic. But I see these more as individual problems rather than a systemic problem. Just my opinion. Plus, with rates coming down, and by the rates coming down, it makes the CDs or the T-bills or whatever they're going against worth more. So part of that's helped out, just having the rates come down. We'll see what happens Wednesday. But my guess is we're going to see a lot more mergers. We're going to see a lot more acquisitions, a lot more movement in the banking space. Because I think we do have some of these banks that might be smaller and maybe undercapitalized, and it might be a problem, again, on an individual basis. The other thing to remember is that hundreds of banks, and I'm probably over exaggerating there, but there's many banks each year that go under. Maybe not to this size, but we don't make a big deal out of them because we don't hear about them, we don't see them. But a lot of banks do go under, and instead of going under, some of them get purchased. So keep all that in mind when you're looking at all this kind of stuff. These are big banks, so they're all over the news. The biggest thing is call your advisor, talk to them, see if you have any exposure on any of this stuff. Most of you probably don't, other than some minor exposure if you're in mutual funds or index funds that happen to have Credit Suisse as a portion of your overall assets. But again, that's why you diversify in ETFs and mutual funds so that it's just not one individual stock. So again, unless you literally have UBS or Credit Suisse as a stock, it may not be an issue. You can talk to your financial advisor, and as always, Dickey out.